Good morning. Welcome to the special investment meeting of the Teachers Retirement Board for December 12th, 2024. I'll start by calling the roll. Kevin Lou.
Kevin Lee, Mayor Adams, present.
Yeah, what's going
Need somebody at mute.
There we go.
I'm sorry, it fell.
on? Thomas Brown.
Present, good morning, Patricia.
Good morning. Karina Powell. Oh, Allison Hirsch.
Present on behalf of Controller Brad Lander. I'm also joined by our two new trustees, Ricky DaCosta and Donald DeRosa, who are.
Victoria Lee
Good morning, present.
and Christina McGrath.
Good morning, Patricia, present.
We have a quorum. I'll turn it over to the chair.
Thank you, Patricia. Good morning, everybody. We'll start with passport funds, third quarter 2024 performance review with Goldman Sachs.
Thanks, Tom.
Good morning, Amanda.
Good morning. I'm gonna have Gina from my team pull up the third quarter report on the Zoom. Can you flip, Gina, to page 22? Perfect, okay. So just quickly, a recap of the third quarter passport fund results. As of the end of third quarter, assets in the passport funds were around 21.5 billion. 19.5 of that sits in the diversified equity fund. And the third quarter actually did have some market volatility. You wouldn't necessarily know it to look at the returns of the third quarter here on the page. Across the board, positive results for each of your passport funds, but we did in early August see a bit of a sell-off in response to some unexpected or less than expected employment news. We did subsequent to that see more favorable news coming out in the following days and some calming comments from Fed Chair Jerome Powell, all but committing to beginning to cut rates in September. Which ultimately did happen. In September, we did see the Fed cut rates by 50 basis points, which was their first cut since March of 2020. And so we did end the quarter in positive territory across the board. The diversified equity fund for the quarter up over 6%. And calendar year to date through 9/30 up over 18% for the diversified fund. And your strongest performing fund year to date being the US equity index up close to 20% year to date for September. Unless there's questions, I'll jump forward for a quick October update as well.
Questions for Amanda?
Gina, can you flip to the October flash?
Over 2024 performance review.
Great. So after closing out the third quarter in strong territory, we did have a little bit of negative market results in October. Really two drivers of that. One being primarily uncertainty around what would be the upcoming US elections. And we also had, particularly in international markets, a bit of a pullback, especially in some of the emerging market countries, so India and China, that were more of a drag on returns. So you can see looking at the month of October, so diversified equity fund down 1.76% on the month, but still on a year-to-date basis through October, up over 16%. And the active managers within the diversified equity fund did help provide a little bit of downside protection there during the month. But certainly the international piece was the key drag on performance during October. And lastly, I'll just have Gina flip and we can do a quick November update as well.
Great.
Thanks, Gina. So for the month of November, as you all are very aware, we did see the Republican Party end up winning not just the White House, but also both houses of Congress. And so the markets did react positively to that. A couple reasons for that. One being that this administration is expected to implement tariffs, to re-up the Tax Cuts and Jobs Act, and also be, I think, more accommodative to US oil and gas production. So all of those things really are expected to boost domestic growth and be, I think, more favorable to financial markets. And so that, coupled with the fact that we did see the Fed also cut rates by another 25 basis points in November, led to a positive month for US markets. You can see the Russell 3000 index up 6.6% for the month of November. We did again see negative results from emerging markets, in part due to the expected negative impact of this tariffs program on specifically China and Mexico. So you can see the emerging markets index about halfway down the page, down about 3.6% for the month.
Thank you, Amanda. Any questions for Amanda? Great. Then we move on to our pension fund performance update. Steve, take it away.
Great, thank you, Mr.
Thank
Chair,
you.
and good morning, everyone.
Morning.
Actually, I'm gonna give you a quarterly update, just kind of an update on, echoing again, some of the issues that Amanda touched on earlier. Really just a brief, update on the economy, what's going on in the market, and then food for thought in terms of how it's impacting your portfolio, and then a performance review through the end of September. Maybe if you can go to the first slide, Kate. As we usually do, we look at inflation and the headlines around inflation. Obviously, with the election of Donald Trump in November, concerns are about an uptick in inflation in 2025 and beyond. And again, as Amanda talked about, you know, the impact potentially of tariffs, tax cuts, and immigration policies may certainly be drivers of inflation. On the next slide, a quick look at where we are on inflation. This is actually a little bit delayed. We had CPI come out yesterday, which moved up from 2.6%. You can see it there in the white, to 2.7%. So inflation's been a little on the sticky side. And there you've got core PCE still at 2.8%. CPI ex food and energy, or core CPI, is still at 3.3%. So certainly moving very slowly down towards that 2% target that the Fed has, but in a very slow fashion. On the next slide, just a look at the progress on inflation here and abroad. So in addition to the US in red, you've got the UK in light blue or aqua blue, and the Eurozone in darker blue. And you can see that inflation's come down nicely towards the 2% level for all three of those central banks and economies. On the next slide, a look at employment. We had somewhat of a reprieve or an increase in job growth in the month of November that was reported on December 3rd, with coming in at plus 227,000 jobs created. That was off a very low 12,000 jobs created in October that was impacted negatively by the Boeing strike, perhaps more importantly by two major hurricanes hitting the eastern seaboard. So employment is slowing, but still relatively solid. And you can see on the next slide, the unemployment rate, although it moved up a little bit in the month of November, from 4.1% in October to 4.2%, it's still relatively low. And we're still not yet back to where we were in terms of the participation rate pre-pandemic, but stalled down a little bit there, around 62.5% of working population. On the next slide, look at economic growth and the expectations going forward. So obviously, the impact of tariffs depends on our trading partners' responses and how much of that is absorbed by the companies. And that will certainly drive inflation. I think the second quote there is important because Amanda touched on it as well. It's the response we get from our trading partners that can potentially really make an impact on global growth opportunities and inflation depending upon the response. So there was some rhetoric, at least early on, about potential for pushback on the part of Mexico, and we'll see how all that winds up. On the next slide, from an economic growth standpoint, we've actually enhanced the slide with the help of Dan Haas behind me. US GDP growth still solid at 2.8% year over year. Eurozone a little less than 1%, struggling somewhat. UK just about 1%. Japan a little less than 1%, and China up 4.6%. Amanda also mentioned that as well in terms of growth slowing down. They have a 5% target. So for the Chinese government, 4.6% isn't really draping yourself in glory, although on a global comparative basis, it's still quite strong. On the next slide, in terms of Fed rate cuts, the Powell has said he's certainly supporting rate cuts. The market's pricing in a little over an 80% chance of another 25 basis point rate cut on December 18th next week. As Amanda said, we had a 50% rate cut in September, followed by a 25 basis point rate cut in early November. And again, expectations are for an additional rate cut coming up. But the Fed's also reflected that they're not in such a hurry to reduce rates. Given the change in administration, given the stickiness of inflation, given the strength of employment and growth, the Fed can take its time and will probably move at a very deliberate pace in terms of rate cuts in 2025. The market's actually priced out two rate cuts. It's pricing in right now another 50 basis points of rate cuts in 2025, assuming we get another 25 next week. But again, a gradual move down to rates around 4% on the short end of the curve. On the next slide, just a look at where we are across the central banks. As I said, we're expecting a rate cut again next week by the US Fed. Bank of England is at 4.75. The ECB, the European Central Bank, actually cut rates 25 basis points today to 3%. Japan is actually moving the other way, raising rates, but coming off of a period where they hadn't raised rates in quite some time, and reflective more of inflation kicking up a little bit more in that economy. We had a couple other developments yesterday. The Bank of Canada actually cut rates 50 basis points. It's two back-to-back more aggressive rate cuts. And this morning we had the Swiss National Bank also cut rates 50 basis points, really focus more on their currency being too strong. On the next slide, a look at lower official rates as the Fed cuts rates, but volatility and higher long-term yields on the further out the curve. You look back to where we were in terms of 10-year US Treasury yields at the beginning of the year, they're around 388. Today they're around 430. And we've actually seen an increase in term premium based on a number of factors, which I'll talk about in a few minutes on the longer end of the curve. On the next slide, a quick look, you've seen where we are. We basically disinverted the curve at 2s to 10s. And not by much, unfortunately. Today it's about 12 basis points, but the next chart I'll show you shows just a 1 basis point differential. You can see where we were most recently in red towards the top. It's a pretty flat yield curve with a slight premium for investing at the curve, slight but not yet compelling. And again, the expectation is for short rates to continue to move down in terms of T-bills 3, 6, and 12-month issuance and levels as the Fed continues to reduce rates. On the next slide, just to look at where we've been. We have now a positive slope yield curve. You can see 2-year yields at the time of the snapshot at the end of November, 4.26, and 10-year yields of 4.27. So not much of a curve, but a slight premium, but certainly disinverted. And as I said this morning, that yield curve is positive by about 12 basis points. Let's skip the next slide and maybe talk a little bit about credit spreads. You can see credit spreads are actually very, very tight. High yield in orange is about 258, 260 basis points above comparable US Treasuries. Not necessarily compelling, but reflective of a strong economy and declining default rates. And in the investment grade space, you can see that in white, credit spreads are only about 78 basis points. So constructive, again, reflective of a solid economy, attractive total yields relative to where they were a couple of years back, and modest to low default rates. On the next slide, just some headlines that we saw certainly more recently. The Trump trade marches on with the election of Donald Trump, and as Amanda talked about, a sweep of the House and Senate. or I should say, control of the Republicans by the House of Senate necessary to sweep. There is expectations for him to implement policies and changes that could potentially be constructive or business friendly. We've seen a return of animal spirits in terms of prices of risk assets are moving higher. Volatility around rates, somewhat of a relief rally towards the end of November with the selection by President-elect Trump on dissent as his U.S. Treasury Secretary, and again, more of a relief rally. The last point is also interesting too in terms of private equity. I think this is a recognition of a couple things. Firstly, the free money is no longer available, that we have higher terminal rate Fed funds rates. We think it'll be around 3.5% to 4%, probably closer to 4%, and higher long-term rates, given a number of things, the number of the amount of deficits we're running, the amount of issuance we're going to see on the as long end of the curve, and again, an increase in term premium associated with potentially expectations for higher inflation over time. It also means that there's lower expected multiple expansion, and that your private equity managers, when they come, they always talk about value creation. They're gonna have to do more to deliver on operational efficiencies and strategic vision for their underlying companies. On the next slide, a look at benchmark returns, focus on the public markets. You can see there's a lot of green on the screen, so it's been pretty good outcome, certainly short term, and driving some of those longer term numbers into the green. The exception here is U.S. governments. Obviously, we had quite a backup in yields at its low point pre-pandemic. The U.S. Treasury 10 years and into the pandemic touched, I think, about 67 basis points in yield. Again, they're around 430 today. So significant backup in yields, higher yields, lower prices. And you can see that evidence in, say, 3 years in terms of that dramatic backup in yields. Everything else is in green. I think another important part about this slide is if you look on the far right-hand side, those are the expected 10-year annualized returns across, it's the average of the 5 different general consultants for the 5 different New York City retirement systems. And you can see expectations are for equities to return, say, 6.7%. On average, U.S. equities, 6.7%. If you look at that relative to where we are in the 1-year space, we've delivered a 35% return in the Russell 3000 through the end of September. Year to date, I looked this morning, the Russell 3000 calendar year to date is up fully 28%. So really quite a return, and something certainly not to be expected on an annual basis, so that we've had 2 pretty solid back-to-back years coming off of a very challenging 2022. Next slide. Let me skip the next slide, move one more slide. So again, the big news of the day is we've got a change of administration with a change in policies coming in. And we can see that the President-elect Trump has put a pretty, I guess, reasonable economic team in place to help navigate that aspect of the economy, of his mandate. On the next slide, just some food for thought in terms of growth. Growth has been very resilient despite significant rate hikes. You look on the left-hand side, in March of 22, it's when the Fed started its rate hiking cycle. Notwithstanding the fact that rates were moving up, U.S. real GDP growth was actually positive and pretty consistently positive, again, coming off of pandemic and throughout the pandemic, but actually quite strong results through September 2024. As I mentioned earlier, annual GDP growth rate through the third quarter is 2.8%. Trend is around 2 to 2.2%, so it's above trend and again, very resilient. On the next slide, consumers have also been resilient. You can look at this and see the personal consumption expenditures relative to GDP and the contribution. Certainly consumers have been spending, notwithstanding the rate hikes as well. On the next slide, I'll look at inflation and questions as to whether it's coming back. And here, this actually is an interesting slide. It looks at CPI relative to where it is today, relative to where it was in the 1970s through the 80s. And you can see the dual humps there in dark blue. That's the 73 oil crisis and price shocks and the spike in inflation. And we saw the same in 1979. And if you look where the green ends, sort of to the slightly to the right of the middle, reflects where we are now. And the question is, are we going to see a resurgence of inflation? And the market's still questioning that, again, given the stickiness of inflation, and the current, expectations around policies for the new administration. Let's skip the next, slide. That's 2 slides. Maybe
Yes.
slide 25, Kate. Default rates are declining. As I mentioned earlier, credit spreads are incredibly tight with high yield at around 260, and investment grade in the 70 basis point range. And you can see that's evident by the fact that we have a strong economy, a resilient economy, low, and even though steady inflation, and declining default rates, which tell a relatively positive story for fixed income. On the next slide, I think this is an important slide also. We see 5.6 million new people immigrated to the United States since the pandemic. That certainly helped fuel the availability of employment or workers, and it served to keep wages a little bit lower than normally would have been. And there are questions of whether that trend continues or under the Trump administration it is reversed. Corporate profits on the next slide, you can see they're relatively strong, coming in at about 13%. On the following slide, you can also see expectations of projected profitability are also at record highs, slightly under 14%. So it's a very good backdrop for U.S. equities. And again, with expectations of potentially a more regulatorily friendly administration coming in, there might be a return of animal spirits, more mergers and acquisition activity, and again, sustained growth. Maybe move 2 slides ahead. I talked about investment grade credit spreads being tight. You can see in the far left-hand side of the slide where they stack up from a yield and spread basis on the bottom. And historically, they've typically been wider, averaging around 100 to 120 basis points above comparable treasuries. Where they are right now, at around 78 or 80 basis points, again, is at an historical low. Some good reasons for that, but you have to question as to whether that will widen out over time, particularly if the economy cools. On the next slide, just a look at the deposits that are still, or investments, I should say, that are still in money market funds at $6.5 trillion. It's a lot of dry powder. Those rates are typically, money market rates are typically driven by Fed policy. As the Fed continues to cut rates, the expectation is for money market yields to continue to move lower, and potentially at some point, investors start to move out and buy longer duration bonds or corporate bonds to pick up a little bit of yield further out the curve. Let's see, why don't we skip ahead, Kate, to slide 34, please? Just a look at U.S. fiscal policy. This is one of the thematic themes that we think will drive, will be a consideration for rates longer term, and potentially for the market. So there's a few things that are of concern in terms of the level of deficit spending that we've been experiencing in the U.S. for the last several years. There's questions and concerns about the potential for a U.S. Treasury debt downgrade. Right now, it remains A rated by Moody's, S&P and Fitch rated AA+. But Moody's does have us on credit watch as of November of last year, given the amount of fiscal deficits that we're running. We also have Treasury auctions. I'll show in a moment, we have over $9 trillion of new issuance hitting the market next year, again, maturing that's being recycled, and new funds that need to be raised again to meet our deficit spending. But we continue to watch U.S. Treasuries. As I mentioned, term premium is starting to widen out a little bit, around 20 or 30 basis points in 10 years. And the question is, at some point, could the level of deficit spending start to impact the valuation of the dollar relative to its peer competitors? On the next slide, just a look at where we are in terms of debt outstanding. At this point, our Treasury debt obligations outstanding are about 100% of GDP, slightly under $28 trillion. And the estimates are for that to continue to grow quite dramatically and quickly, unless there's been a change in the profile and the pace of spending that we have by the federal government. But again, if you look back historically, we're almost at a high where we were at the end or during World War II, where deficit spending was just very, very significant to, again, fight the war effort. On the next slide, you can look on the far right-hand side in blue. Those are expected or projected deficits for the next several years. Again, not insignificant in terms of their size and impact on the economy and rates. Deficit spending oftentimes is very good for the economy because it puts even more economic activity and money into the marketplace. Let's skip the next couple of slides just to maybe slide 39, Kate. Yeah, one more. There we go. As I mentioned earlier, you can see U.S. Treasury is expected to issue around $9 trillion in new debt this year in green. Again, that's at a near record high, certainly from the last 25 years. We skip ahead a couple slides, Kate. 10-year Treasury premium. And here you can see, I mentioned earlier, the term premium is starting to widen out. It's reflected in the yields that we pay, or the U.S. Treasury pays for longer-term debt obligations. And now let's shift over to Teachers Retirement System's performance reporting through the third quarter through September 30th. You can see on here, it's a great screen. It's all green, which is a wonderful outcome. For the quarter, you can see your total plan, including private assets mark to market through June, are up 5.3%. That's a great outcome, not to be expected every quarter, but a really good outcome in the short run. Yeah. I think more importantly, I look at it 10 years to look at where we are, where we've been relative to the other benchmarks. The policy return, which would be expected if we were at policy rates, and we're moving towards that through pacing plans. Again, it's good to see a lot of green on the screen regardless. On the next slide, just a different way of presenting where we are relative to that 7% target return rate we have for your portfolio. And you can see that black line is a 7% target rate over a prolonged period. And you can see based on where the performance has been above and below, right now you're above that return expectation, which is a good thing. You want to stay above the dark line. On the next slide, a look at net public market returns by asset class. And again, it's been a little bit of a whirlwind coming off the pandemic and given the resiliency of the economy, and that's reflected in market returns. These are teachers' net public market returns by strategy. And again, a lot of positive things on the screen. Again, the exception has been core fixed income, which has struggled a little bit with the significant backup from very, very low levels of yields in 2022 to today. But otherwise, it's been a really kind of a wonderful outcome. U.S. equities, your public market returns by equities in the 1 year space is fully 35%, which is, again, phenomenal and not to be anticipated or expected every year. On the next slide, a look at where your public market excess returns. And here you can see that it's kind of a mixed bag. We're focusing on 10-year excess returns, a little bit more negative than we'd like to see. We'd like to see a lot of green out there. And we're looking at ways to improve our performance across all public asset mandates going forward. On the next slide, just a different way of looking at your public market returns and holdings. You can see the holdings in terms of assets on the left in that round pie chart. What I would focus on here is I look at the purple. The dark purple is actually your portfolio. The light purple is relative to the benchmark. So looking at longer term, you've had pretty much performance on par with the benchmark in U.S. Treasuries out 10 years. U.S. equities out 10 years. World ex-US, we've outperformed slightly, which is great. Pretty much flat around emerging markets in 10 years. A slight underperformance for core fixed income. High yield is about flat to the benchmark, still a good outcome, and cash is slightly up relative to the recent index of 3-month Treasury bills. On the next slide, look at public market total annual fees. Your fees, again, this is just for the third quarter of 2024 fiscal year. You can see, calendar year. Your fees you paid were $26 million. Little over $100 million on an annual basis just for public market management. We continue to focus on this. We're going to try to put together more metrics to give you more insights into the fees you're paying. And we're putting ourselves in a position where we can better negotiate fees down. And we could talk about that in executive session in terms of how we're doing that, but we've got some wonderful technologies and insights that certainly support that going forward. On the right-hand side, you can just see the breakdown. Overall, your public market fees on average, you're paying about 12 basis points. And again, we continue to work that lower, and our expectation is for trustees to hold us accountable for moving that level down over time. On the next slide, look at TRS's net private market returns by asset class. Again, a fairly positive story. Some headwinds still with private real estate with the backup in rates and concerns around retail and office, which is you're technically underweight, but a very strong outcome. I think the most important thing for this slide, again, looking at longer term, 10 years and since inception, even though private equities for the 1 year through the end of September have delivered just a 4.4% return, it's important to remember that since inception, that return level has been over 11%, and pretty consistent across the last several years in terms of 5 and 10 years as well. Infrastructure should be highlighted. Petya, Blair, and her team should be commended. Look at the return stream and how steady it is at 10% plus. For 10 years, over 11%, close to 12% returns, outperforming the benchmark consistently by about 200 basis points. On the next slide, this looks negative because if you look at private equity, it looks like we've had just a terrible outcome in terms of underperforming by 2,100 basis points. But remember, the Russell 3000 is up 28% year to date. There's a 300 basis point liquidity premium on top of that. And again, I don't think that's reflective of the value of private equity in your portfolio. It's noteworthy because it has actually occurred, but again, it's being skewed by the last 2 years of significant performance of the Russell 3000 when private equity has been more of in a retrenchment period. On the next slide, just to look at your net private manager returns a little differently. You can see the assets under management on the left in the pie chart, and then the performance relative to those benchmarks longer term. And again, we think that's the right way to look at it. Again, my point earlier about the outperformance and the really significant steady performance in infrastructure, you can see in 1 year, 3 year, 5 year, 10 year, since inception, our portfolio, or I should say your infrastructure portfolio has actually outperformed its benchmark significantly, which is a great outcome. Let's skip the next slide for the sake of timing, and I'll look at some of the rebalancing activities for the third quarter of calendar year 2024. Again, we were selling our winners. U.S. Treasuries had rallied significantly, so we were rebalancing the portfolio to sell some of those overweight positions and buy some of the underweight positions, which are world ex-US or non-US equities. We also were raising cash in certain areas to make liquidity payments and capital calls for private assets. You can see that raised by the cash desk. On the right-hand side, you can see what we were buying. We actually rebalanced the portfolio for fixed income as well. And that includes the elimination of tips, which are no longer part of your strategic asset allocation. And with that, I'll open up to any questions. I know we kind of threw a lot at you. I apologize. I have 15 minutes to do a 40-minute presentation. When Dan and I start working on the slides together, we just can't help ourselves and we get carried away. But
Well done.
there's
You can
it.
speak for
Thank you
for the time.
Thank you for saying that,
Very
Tom.
well done. Thank you.
If it's okay, we'd like to, Dan Haas is actually our interim chief risk officer as Ed's moved on to a position of head of public markets. And we've integrated our public market teams, John Mersberg's team, Robert Fang's team with our quantitative experts to really get better outcomes. And we can talk a lot about that at an appropriate time. But Dan's moved into the role as the interim chief risk officer, and will be interviewing for the risk officer position, although he's been functioning in that role for a while now. So with that, Dan, I'll turn it over to you.
Good morning, Dan.
Good morning. And you want to hear me okay?
Yep.
Yes.
Well, thank you for your time, and it's great to be standing in front of you again today. I kind of served in this capacity before, during COVID, and so we were able to bring Ed on board. And I'm pretty happy to be here today, kind of extending some of the conversation that he's been developing in the last couple of years. Importantly, Ed kind of extended a few concepts that I'd like to lean into, and that's what we're going to do over the next couple of slides. It's actually a pretty brief conversation today.
Yeah, Dan, if I'm sorry to interrupt again, I apologize, but again, the idea is to have Dan function as Chief Risk Officer, as well as Head of Reporting, so we can have a better suite of analytical capabilities, more insights that we can deliver to trustees through, again, the combination of reporting and risk management. So we're trying to build on the good work that's been done before it got here. While it's been here, it's been great, and again, continue on with that. So I work very closely with Dan on a weekly basis.
Yeah, and I suppose the corollary to that is when you see something weird on these slides, my fingerprints are all over it, so. So as I was saying, Ed, I think developed a couple of great concepts that I hope to lean into, as we continue our conversation over the next several quarters, hopefully years, for risk. He introduced the idea that portfolio risk is akin to expected return. Right? It's great to think about it because otherwise it really sort of makes the concepts a little more concrete. He also introduced a concept that we have on the slide here, where he's decomposing the drivers of risk among a couple of different factors. We're looking at market risk. That's that blue market portfolio kind of section of the main table there. We look at your allocation decisions. That's the policy benchmark section in green. And then we look at the actual portfolio as it's invested, which is for the orange sections. So as we kind of start with this slide, there's a plan summary. The markets are described by this market portfolio, which is simply a 65-35 blend of equities and public fixed income. The allocation decisions, again, those are described by the policy benchmark. So that's the strategic asset allocations we improved over the last year, put into weights by the individual strategy decisions that we made and that implemented over the last year or so. And then, of course, we've got the portfolio that's in red.
Okay.
So we look at that market portfolio, you can see that the mix implies a certain sensitivity to rates. We have a rate duration of 2.1 years, and we have a spread duration of 1.2 years. That's pretty consistent with what we've seen in the past. And then when we model the volatility of the portfolio, you see that we arrive at a portfolio volatility of 10.2% there. That's actually unchanged from last quarter. We also measure the portfolio beta to the S&P 500. You can see that's 0.63, which are, again, consistent with what we've seen in prior quarters. So again, this gives you sort of a baseline of what you can expect, were we to simply go passive and create that sort of baseline mix of investments. When we move on to the policy benchmark, you can see that in the center, we've allocated slightly less to equity, 64%, and we're targeting less rate exposure than you'd see in the market portfolio. And that results in a lower overall predicted risk of 9.3% and a lower beta to the S&P at 0.55 versus 0.63 of the market portfolio. Again, these are pretty consistent with what we saw last quarter, and even as you look back, these numbers don't change a whole lot. And then finally, we can turn our attention to the actual portfolio. This includes the impact of the actual manager selection that we have in the mix. And also, we incorporate the parking place adjustments that we make for the alternative investments. Because we have to allocate more relatively to certain strategies as we ramp up to our target investments for alternatives. Here, you can see that we're modeling a 9.8% overall risk and a 1.8% active risk. The active risk, again, is really just the amount of variability we would expect in the excess returns of the portfolio. We have a portfolio beta of 0.59. So we're seeing a little bit more risk here than will be implied by the benchmark, but it's consistent with what we've seen in the past. So the main takeaways from this page, it's the most important summary of risks in the portfolio. There are kind of two things you can draw from that. The risks of the portfolio are closely aligned with the benchmark, which is what we tend to be. And that portfolio is running a slightly higher level of risk, meaning that we expect it to outperform in a risk-on environment, bull market, but it would underperform a bit more. You see more volatility in the bear market. Expected performance of the portfolio really is driven by market factors more so than our allocation decisions, but I think that's again to be expected. And then finally, I'll draw your attention to the charts on the right where we plot the total risk and the active risk over each of the last 12 months. Again, market volatility is trending lower, and you can see that both the portfolio and the benchmark lines are following that blue dotted line, the market volatility. And again, it's just another indicator that market factors are really driving overall risk in the portfolio. The bottom one, the active risk there, again, that's constrained with a fairly narrow bounds. Let's call it 1.8 to 1.95%. A little blip there in April, where it trends down. That's probably more due to technical factors as we kind of cut over to a new policy benchmark weightings, as we implement your strategic asset allocation. If you go to the next slide, please, Kate. Thanks. So this one I'll be pretty quick with this one. Again, seen it before, and as we've been kind of talking about ever since COVID, really. These are your allocation slides, and here we're comparing your asset allocation by strategy to how risk is allocated among the portfolio. And as seen in the past, you can pretty clearly see that public equity, even though it's a little less than half of the portfolio allocation, consumes 2/3 of your risk, and that's again to be expected just because those asset classes are so volatile. You see a similar trend there for private equity, where it consumes an outsized portion of risk relative to how we're actually invested there. The takeaway here is that it really has to do with the importance of dynamic rebalancing. If we were to leave the portfolio alone, not rebalance, you'd see that the actual allocations would trend toward the risk allocation, and that would leave the portfolio exposed to more drawdown risk and more overall volatility. So it's sort of underlines the point that we pay a lot of attention to how the equity asset classes are diversified and being a little more careful about the positions we take in there in the mix of managers. And again, that's something that Ed and team are really focusing in on. And, now as he kind of takes his new role. Go to the last slide there, Kate. Thanks. Okay. This one is actually one of my favorite slides. What it does is it compares the volatility of your investment strategy selections and the portfolio as a whole there to the results that we saw last quarter. We scale the volatility down from sort of an annual measure, how we normally report it, down to a quarterly horizon. And then we just plot in those triangles, the actual results that we saw in the third quarter. And the nice thing about this is it gives you a sense of what's normal, right? We would expect, most of the time that the results will plot somewhere inside of those bars. And then in rare occurrences, 15% of the time, to the upper end, and say 15% of the time to the lower end, so you go up distribution, they'd fall somewhere outside of that. But the nice thing about this is it gives you a sense of which asset class really kind of outperform how we expect them to perform. And we had great results in the third quarter across the board, but you can really see that public fixed income there performed much better than we normally expect it to. That was driven really where rates play there. We saw interest rates come in a bit, so yields declined, prices went up. If you look at the 2-year rate, it was down about 100 basis points. The 10s were about 70 basis points for the quarter, and that really drove a lot of performance in the fixed income portfolio, and kind of showed you those results. I'll stop there. Happy to take any questions if you like.
Any questions for Dan? Thank you.
Thank you.
I think that wraps up our business in the public agenda. Is there a motion to move into executive session?
So moved.
Is there a second?
Second.
Great, any discussion?
Were you noted?
Oh, for the record, then let the record show
She was
that.
trying to check who was the second, who made the motion in the second.
It's all right.
No,
I'm seconding.
No, no,
Okay.
yeah, I'm just saying, let the record show that Anthony Giordano was present.
I did.
Got that, thank you, Sophia. So it's been motion, this motion seconded, any discussion? All those in favor of going into executive session, please say aye.
Aye.
Those opposed say nay. Abstentions? We're in executive session. Let the record show that we are back in public session. We'll have a readout now from Ron Swingle.
Thank you. In executive session of the passport funds, there was one manager update. In executive session of the pension fund, there was an update on preliminary performance data. There was an ETI presentation, consensus was reached. There was a real estate presentation, consensus was reached. There were two private equity presentations, consensus was reached on both. There were presentations for 4 different asset classes, consensus was reached for all 4. And lastly, a public equity search recommendation, a holdover from a previous meeting, was presented and consensus was reached.
Thank you so much. This board would like to thank Sophia, our recorder, much appreciated. And our own IT tech person, Richard Santana. Thank you so much for all your work. Any other business in public session?
No, I'd like to make a motion to adjourn though.
And your motion has been accepted and acknowledged. Is there a second?
Second.
Any discussion? All those in favor of adjourning, please say aye. Those opposed, say nay. Abstentions? Let the record show that we are adjourned. Thank you. Thank you, everybody. And